Okay, hi everyone. Second video here for chapter 7. Right, last time we were talking about and we finished with capital assets. Right, we said capital assets are generally going to be non-business assets, right? So things that an individual would own, whereas ordinary assets and 1231 assets would be those owned by a business, right? So the current assets and the non-current assets there respectively. With regard to capital assets, right, it can be things traditionally like stock, right? That's the big thing we're going to be looking at in this chapter. It can be your house, your car, a collectible. When you sell it, right, that's a disposition event. And essentially it's going to be your amount realized, what you sold it for, I don't know, $1,000, minus your adjusted basis for purposes of this chapter, what you paid for it, I don't know, $700. Right? And the difference there is going to be your gain or loss, in this case, a gain, right? You just pay tax on the gain, like that incremental amount, not the gross selling price. We said that whenever you have like blocks of stock that you sell, typically you're going to use the FIFO method. However, it is possible to use specific ID, or if it's a brokerage account, the LIFO method. 7.4 there shows you sort of the different tax outcomes from that. We said typically for classification purposes, if you own it a year or less, that's a short-term gain or loss, and it's going to be taxed at those ordinary income tax rates. If you own it for more than a year, right, it's a long-term capital gain or loss, and it's going to get those preferential rates. If you hold certain types of assets, more than a year capital assets, we can depart from that. So for example, if there's depreciation recapture, that's going to be taxed at 25%. And then collectibles and a portion of the gain potentially from qualified small business stock can be taxed at 28%. Okay? So this is sort of the general rule right here with long-term capital gains, right? 0, 15, or 20. You can see most people are going to be paying 15% on that. The first exception, right? We talked about this in the last video, depreciation recapture, where we try to make up for the difference between offsetting ordinary income with depreciation expense, and then on the flip side, getting the preferential rate on the sale. IRS doesn't like that, so they recapture the depreciation. And then now, right, to kind of pick it up where we're going to be looking at collectibles and qualified small business stock, right? So collectibles are going to be taxed at generally 28%. So things like art, rugs, antiques, metal, stamps, coins, right? Pokemon cards, right? That would be a collectible. The next is qualified small business stock. Right, so the idea with this is it's stock that you had to have held for 5 years, and specifically for it to be qualified, right, the corporation has to have a gross tax basis in its assets before and after of 50 million or less, and 80% of the value of its assets are used in an active way in the business. Okay, so it's basically like a relatively smaller business that you buy stock in and that you hold it for more than 5 years. In this situation, depending on when you acquired the stock, some or all of the gain is excluded, right? So some is excluded, and the leftover, right, is going to be taxed at 28%, right? So it's kind of the leftover amount there. So this is kind of giving you the dates on it, right? So first off, it has to be the right type of stock, qualified small business stock, qualified small business stock. Sorry, let me erase that. That's just like a qualified small business stock. And you had to have held it 5 years, right? If you meet those two things, then you go down here and you say, well, when did I acquire that stock? Because that tells me how much I exclude. Whatever is left over after I exclude that, it's going to be taxed at 28%. So by way of example, right, let's say that we acquired it after September 27th, 2010, right? And there was a $100 gain on the sale. So it's the right type of stock. We held it for 5 years. There's a $100 gain, right? Well, all 100 is going to be excluded, right? 100, and 0 is included, right? So you're not going to have to pay any tax on that. Let's compare that with, right, if we bought it in this window right here where it's 75%, right? So 75% is the amount here. If there was a $100 gain, right, what happens is 75 of it is excluded and 25 is included, and that amount is going to be taxed at 28%, right? So both of these, again, assume that you meet this. If you have the right type of stock, you hold it 5 years, then you use the table to tell you how much you exclude. Whatever the leftovers are that you include, you're going to pay tax at 28%. So let's look here. Let's see what the number is on this. It is 7.6. Okay, so let me pull that down. Have a taxpayer here who, right type of stock, they bought it in 2015, so they've held it 5 years. The gain on this, they sell it for 200 and their basis is 50, so they must have a $150 gain. They bought it in 2015. Oh, that's after that. 100 is excluded. Right, so of the $150 gain, 150 is excluded, right, and 0 is included. So in other words, we're not going to have any tax liability from this. If we were to change the facts, right, and they bought it in 2020, and let's just pretend that it's 2023 or 2024 right now, we haven't held it 5 years, right? We don't meet that 5-year requirement. Because we don't meet the 5-year requirement, that entire gain is going to be just treated as a long-term capital gain in that case. Okay, next, let's talk about the netting process for capital gains. And you're definitely going to need to know this for the exam. Highly testable here. So yes, it's true. One shot. If you sell just a long-term stock, I held this for 2 years and I made $100 on it. Yeah, you're going to pay long-term capital gains on this. Hey, you sell one piece of stock and you held it for a week, it's going to be short-term gains. There's a gain. That is true. Where it gets messy is when you have in a given year a bunch of sales of stock, right? So what you're going to want to do here, right, you don't just like report them individually and then deal with it that way. They have a netting process that you have to do. And the netting process essentially says this, right? First thing you're going to want to do is look at all your transactions and say what were short-term and what were long-term, right? So I don't know, maybe these two were short-term and those 3 were long-term, right? And that could be a gain, that could be a loss, right? But first thing is just say, what's my short-term? What's my long-term? Okay, once you get that, right, internal to the bucket, right, you need to net all of these transactions. In other words, the gains offset the losses in the short-term bucket, the gains offset the losses in the long-term bucket. In doing so, you only have a couple different types of outcomes that can happen, right? It can end up being positive, positive, negative, negative, or positive, negative, negative, positive. So they'll end up either being the same, and you go to step 2A. Now, after doing step 1, if it's the same, right, if it's like positive, positive, hey, that's great. You do 2A there. If they're different, right, say it's like positive, negative from those buckets, right, different, you go to step 2B, where if you do go to step 2B, then you got to net them again, right? So net again on there. And whatever the bigger one is, the raw number, that's going to control the holding period on there. This is not something you're going to hear once and be like, I understand this. You're going to need to look at the example on the next slide, the slide after that, and then in the Excel problem and in the homework. And then you're going to come back and you're going to read this and you're going to say, oh, okay, now it makes sense. So I'm just kind of giving you the rules right now, but until you give this some numbers, it's not going to make much sense. So first off, let's unpack this just kind of simply here, right? We got our long terms, we got our short terms, and imagine we have 6 different taxpayers. So each of these situations are uniquely different. And we're keeping it simple here, right? We're going to assume that there's just 2 transactions in each for each taxpayer. So in this case, right, our long-term bucket, well, the only thing we have here is a positive, right? And then we have our short-term bucket, we have a positive there. So it's positive, positive, it's the same, right? No netting is involved. We're going to, if we go back here, right, if they're the same, we're going to report them separately in that case, right? So we'll report our long terms, and then we'll report our short terms. If they're, negative, right, they're both negative, then what we can do is offset our ordinary income up to $3,000 with any excess being carried forward, right? So here, we put them in the buckets, it's positive, positive, gain, no netting, we'll report them separately. Hey, we have a $100 long-term capital gain, we have an $80 short-term capital gain. Here, right, we have a long-term loss, a short-term loss, right? Negative, negative, they're the same, no netting. In this case, right, we can offset up to $3,000 of ordinary income. So this $180 just offset our ordinary income. Next one, right, we have a gain and then we have a loss, right? So here they're different, right? In these situations, they're different. So we're going to have to net again, right? So 180, right, gives you 20 if you net them. And then what's bigger, 100 or 80? Well, 100 is bigger. Hey, long term, that's what it's going to be. In this case, right, we have negative, positive. So they're different. We got to net them again, 180. It's 20. Well, which one's bigger, 180? Oh, short term on there. 180, right? So we have negative, positive. Again, 20, which one's bigger? The 100's over here. There we go, right? You can see this kind of process here. When it's the same, you put them in the buckets. You do the first netting. If they're the same, if they're both positive, report them separately. Here's my long term. Here's my short term. If they're both negative, you can offset ordinary income. If they're different, you got to net them again. Whatever the bigger number is, controls for the holding period. Let's look at another example here, right? We have a taxpayer that has a $6,200 carry forward loss, right? Capital loss from the prior year. So they must have done this last year, right? They offset $3,000 of ordinary income, and then the leftovers must have been $6,200, right? That $6,200 is specifically 5, right? That's going to be a short-term loss. And then 1.2, which is a long-term loss. This is kind of showing the intersection here of how do we apply that carry forward, right? So first off, what we do is step 1, we got to put our transactions in the buckets, right? Here's our short terms in our buckets. Here's our long term in our buckets, right? So 4 and 7, right? That's going to give us negative $3,000. 3 and 5, that's going to give us $2,500. Then, right, this is almost like we're putting that carry forward in the bucket, right? 5 was short term, 12, right? So 3 and 5 gives you 8, 2,500 and 1,200, right? A positive amount, and then minus 1,200 gives you 1,300. What's the outcome here? We have negative, positive, right? So step 1 is right here. If we go back, right, we just did step 1, we put them in the bucket. And then now we're going to do step 2B because they're different amounts, right? Step 2B, right? So 8 and 13 is 6,700. Well, we can only use $3,000 of that to offset ordinary income. Hey, we're going to carry forward that guy into next year. Just like it came in at the beginning of this year, we're going to carry something forward into next year. Let's look at the Excel problem here. Right, so we have 2 different scenarios, right? They're telling us, hey, here's our long terms, right? We put them in the buckets, and here's our short terms. That's step 1, right? We net them internal. 35 minus 10 is 25. 8 minus 11 is -3, right? So we're positive, negative. They're different, so in that case, we're going to have to net them again. 25 minus 3 gives you 22. What's bigger of those 2 amounts? Well, the 25, which is going to be the long term over here. Larger the 2 controls. Compare that with over here, they flip the short term and long term. Same numbers, right? So we're still at 22 in this case, but the 25 that's bigger, in this case, they flipped it. It's short term, so it's going to be a short term capital gain. Again, something you have to see a few different times on that. Work through the problems, look at the kind of setups with it. So essentially, right, where would you see these transactions? Well, it would be on a 1099-B, which could be part of a 1099 consolidated. So a 1099 consolidated is like a giant tax document that consolidates like a 1099 INT, a 1099-B, a 1099 div. It's a lot of like portfolio income that they put in a single document. Right, well, you normally nab this, you throw it in the software, and then the software is going to spit it out. If it's a true capital gain, right, it's going to be an 8949, right? So stocks, things like that, you'd see on 8949, right, like individual stuff. If it was a business asset, right, so if it's a business asset and they were to sell, you know, an item that's not their inventory, like, hey, we just have a machine or something that we're selling, then it goes on 4797. Ultimately, right, when this gets reported on the 1040, it's going to go to the Schedule D, right, where we have these netting processes. Do be aware that netting process gets more complex whenever you get these 25 and 28% items in play. Do not need to know that for the exam, you know, when that's in play. But you are going to absolutely need to know this guy right here. I could give you a scenario where it's step 2A, right? You just report them separately. Hey, I had, you know, a long-term, it was positive. In that case, I'll report my long-term gains, pay preferential rate on that. I'll have my short-term gains. I'll pay ordinary rate on that amount. If it's negative, like -6 and -2, well, in that case, I'm going to offset ordinary income up to $3,000. The remainder in that case, 5, would be carried forward to the next year. So it's simpler here. You just basically report it separately right here, keep them different, or here you offset ordinary income with them up to $3,000. So this is showing you, right, for example, the 8949, these amounts on here, right, they have you carry it over and it runs into the Schedule D, which ultimately does flow into the 1040. Now, one of the things we've been talking about, right, whenever you sell a capital asset, right, it could produce a loss, right? Maybe you sell it for $500 and your basis is 700, right? That would be a $200 loss. And we said that, you know, generally, if you apply that netting process, you can offset up to $3,000 of ordinary income. There are some limitations on that, right? So the exceptions here are going to be this WRAP acronym, right? So wash sales, related parties, and personal use assets. Let's talk about wash sales, right? So a wash sale, first off, what is it? If you sell the stock, right? So you sell it, and when you sell it at a loss, right? So gains are taxable. This only applies when you sell it at a loss. What you do is you go forward 30 days and you go backwards 30 days and you say, hey, during that period, right, did I repurchase or buy the stock in that period? If that's the case, then the IRS says you are not allowed to take the loss on that. It is a wash sale and you can't take the loss with it. And essentially what you do is that disallowed loss ends up, say, like you purchased it again over here, that will get tacked on to the basis of the other stock. Let me explain the theory to you why they do this, right? It's essentially because you're in the same position before and after. Say you're sitting on a stock, right? And you're sitting on it and it's like $5,000 in the hole, a loss, right? But you think next year, right, it's going to go up in value. So here you are, right, and it's kind of year one, year two. Option one is you could just hold it, right, and then what you get is the appreciation. It goes up in value. A more savvy taxpayer may say this, right, I'm sitting at $5,000 loss, right, I know I'm going to get the appreciation next year, right? I want that appreciation, but here's what I'm going to do, right? If that's the end of the year, I'm going to sell it right here. And then what I can do is take advantage of that $3,000 loss, right? 3,000 of that immediately to offset my ordinary income. And then I'm going to rebuy it and ride that wave of the income up there. The IRS sees through this, right? They say, look, you are basically in the same position over here by doing this. If you have a wash sale and a loss, we're not going to just let you game the system and utilize this $3,000 loss, right? So that's the setup with it there. So here's an example of it. You can look at that with a wash sale. Here's another one. I like this one a little bit better, right? So let's say on day 10, a taxpayer in this case sells 10 shares of ABC stock for $70 that cost $100, right? So they are at a $30 loss, right? So there's a $30 loss. 5 days later, they buy it again, right, for $80. Well, in this case, right, essentially what we did is we say, here's the sale date. It is a $30 loss, right? We went forward 30 days, we went backwards 30 days, and we say, hey, during that window, did we rebuy the stock or purchase it all? Yes, we did, right here, right? Like 5 days later, we bought it for $80. Accordingly, right, because we bought it at a loss and we repurchased it within 30 days, you're not allowed from using that loss. It's disallowed. And what we do then is we say, hey, your new basis in this stock that you purchased is going to be what you played plus the disallowed loss, right? So your basis in this day 15 stock becomes 110, okay? Where you will see these, right, a lot of times on the brokerage statement is there will be a column for them, and you need to make sure when you're entering it in the software that it makes that adjustment for the wash sale in there. So let's look at example 710 on here. Right, so don't worry about these 7.8 and 7.9 for the exam. But 710 here says, we have a taxpayer that sold 100 shares of ABC stock and it generated a $1,000 loss, right? So they sold it. It's at a $1,000 loss. They say, hey, it looks like 13 days later, they bought it again at $41 per share, right? Well, the setup here is we sold it at a loss. We repurchased it within 30 days. You don't get that loss, right? So they say, how much of the loss do you get? $0. They say, what basis will the taxpayer have in the repurchased stock? Well, it's essentially what they paid, right? $4,100 here, plus the $1,000 disallowed loss, right? We're looking at $5,100. Now, one of the things to be aware of is, right, in this situation, they sold 100 and they bought back all 100. Things get a little bit more complex, right, when they buy back only some, right? Buy back only some. Right, so here, right, if they sold 100 shares and they only bought back 40, right, well, in that case, right, they repurchased 40%, therefore 40% of the $1,000 is loss, right? So here was like, the number of shares, right? It was a $1,000 loss, right? That was the loss. Well, in this way, right, there was a $1,000 loss. 400 is going to be you don't get, it's disallowed 40%, and the remaining 600 you do get on there, right? So it's not like if you buy anything ever, it cancels out the entire amount. You do have to prorate it based on how much you repurchase. So compare all, buying back all that you sold with some that you sold. If you buy back some of what you sold, then you have to prorate it there for how much of the loss that's disallowed. Sales that result in losses to related persons, you don't get to deduct those, right? So like husband sells something at a loss to wife, right? You could see that could easily be manipulated to take advantage of that $3,000 that you can offset against ordinary income in there. Likewise, personal use assets, these are kind of the worst of both worlds, right? So first off, if you sell a personal use asset, say like, when we say personal use, this essentially means an asset that you use in a non-business capacity in your personal everyday life, right? So you buy a car, right? Say you buy a DeLorean and then Back to the Future comes out and you sell it and you have a big gain on there, right? You have a $10,000 gain, right? Well, the idea with that is if you sell it at a gain, right, it's going to be income. You get like frowny face, you got to pay tax on that. Compare that with, right, I buy this like beater Chevy or Toyota Camry and I just run it into the ground. I paid, I don't know, 10 grand for it and I sell it for $2,000, right? And I have an $8,000 loss, right? In this case, here's the problem, right? You don't get to take that loss, no deduction. It is frowny, the worst of both worlds in this way, right? So they tax you if you get it at a gain. If you sell it at a gain, any personal use item, but you do not get to take the losses on there. So, they talk a little bit about here of the benefits of long-term capital gains. You can read through this. Loss harvesting basically says this, right? If we're at the end of the year and we're sitting at a $10,000 loss on a stock, right? And we think this thing is just going to keep going down, right? Just sell it now. At least take the $3,000 that you can offset against ordinary income. You get something out of it than riding the wave, for it going down in value. Obviously, this is a facts and circumstances situation. You have to think like, well, how long have we held it? What do we think is going to happen in the future? So on and so forth. But lost harvesting basically says, man, I've gotten beat up on this stock. Let me just get out of it. And at least I can offset up to $3,000 of ordinary income. I can get something out of this loss. All right, let's talk a little bit about investment interest expense, right? So investment income is things like interest, annuities, royalty income, and then any short-term capital gains and non-qualified items, right? So in other words, it's all of that stuff that we talked about, right? But it does not include any preferential items, right? So if there is a long-term capital gain, generally not going to be considered investment income. If there is a qualified dividend, it is not going to be considered investment income. Now, one of the things we have here is investment interest expense, right? So the idea with this is, imagine you borrowed some money to purchase investments, right? Hey, banker, please lend me $100,000. I paid $12,000 of interest this year on that, right? That would be investment interest expense, assuming that I use the proceeds from the loan to purchase these investment income items. The idea with this is you can get a deduction for that investment interest expense up to your investment income, not beyond, right? So let's look and think about this here, right? Step one is going to be figure out your investment income. So it's basically all that passive stuff except no preferential, right? Nothing in there that's preferential. That doesn't make the cut. So, hey, maybe we did this, right? We said we have some interest, annuities, royalty income, a short-term gain, a regular dividend that's not qualified, right? We ran the numbers on all of this, and it's $1,000, right? We didn't include those. Step two says you can deduct your investment interest expense up to that amount. So say that we're looking at $1,200 that we paid as investment interest expense, right? Well, the idea with this is you don't get all $1,200, you get up to your investment income. So $1,000, in other words, the best it can do is take you down to zero. So step one, what is my investment income? Basically all of those portfolio items that don't have a preferential rate. Step two, what amount of investment interest expense, which would be given to you, can I subtract against this to reduce? Well, up to step one amount, not beyond. The best it can do is take you down to zero. Also, be aware, to the extent that you borrow money and you incur that in investment interest expense, and it was for tax-exempt investments, it's not going to be deductible, right? So say that you borrow $1,000 and you use 10% of that amount, the borrowings, on muni bonds that are not taxable, and 90% on taxable investments. You end up paying $50 of interest expense. Well, here's the idea, right? You would say, well, like my investment interest expense is $50. That's the gross amount. However, because you used the proceeds, some of which were non-taxable amounts, they're not going to give you the double dip on this and then let you expense the entire amount. So in other words, $45, you can get, but the $5, namely the 10% related to the non-taxable items, you do not get, okay? So with this, I'm going to end the second video here, and then I'm going to record a third video for the passive activity loss rules. You can read this on net investment income tax. It's basically a 3.8% tax on the lesser of those two amounts. What do we use it for, right? It's really helping to fund Obamacare, that like health insurance through the federal government. So let me end this here.